When we step back and think about BYD, it's a company that's achieving the most explosive growth we've ever seen in the auto business in 100 years. So just put some numbers to it. In 2020,
sales are plummeting, factories are slowing, and once loyal customers are walking away. In 2025, some of these companies may vanish forever, taking decades of heritage with them. What happened, and which brands won't survive the year? The American truck market in 2025 is a complicated place to navigate. On one hand, trucks remain one of the most popular types of vehicles in the United States, both for personal use and for work. On the other hand, the brands that have dominated the market for decades are facing challenges that are forcing them to rethink their strategies, products, and even how they build their vehicle. Ford is a good example of how this mix of pressure and opportunity is shaping the industry right now. In recent months, Ford has been making headlines with its plan to produce a new affordable electric pickup truck. Internally, the project has been described as the company's Model T moment for the modern era, a reference to the car that made Ford a household name in the early 20th century. The aim is to build an electric truck that could start at around $30,000, 0 cents, a price point that would make it one of the cheapest EV pickups on the market when it arrives. Ford expects production to start in 2027, and to make it happen, the company is investing billions of dollars to upgrade its facilities, including a major overhaul of its plant in Louisville, Kentucky. What makes this new truck interesting is not just the price, but also the way Ford plans to build it. The company is moving away from traditional assembly lines and toward what it calls an assembly tree method. This approach involves building parts of the vehicle in parallel rather than in a strict sequence, which can speed up production and reduce costs. Ford's leadership has framed it as a necessary innovation to remain competitive in an industry that is rapidly shifting toward electric vehicles and facing increasing pressure to cut manufacturing expenses. However, while Ford's future ambitions are making news, its present situation is far from smooth. In 2025 alone, the company has faced an unusually high number of recalls, with nearly 100 recalls issued so far this year. One of the most significant was for over 100,000 F-150 trucks. From model years 2023 through 2025, the issue involved a rear axle hub bolt that could fail, increasing the risk of a crash. The company offered free repairs to its dealers, but the scale of the recall added to concerns about quality control at a time when Ford can ill afford to lose customer confidence. It is worth noting that Ford's F-Series trucks, including the F-150, are the backbone of the brand's profitability and among the most recognizable vehicles on American roads. Despite these setbacks, Ford's sales performance in the U.S. has shown some resilience. In July, the company reported a 9.3% year-over-year increase in sales, thanks in part to strong demand for SUVs and pickup trucks. The incentives have played a role in keeping that demand steady. Ford has been offering aggressive deals such as 0% financing for up to 48 months, no down payment, and no payments for the first 90 days. These kinds of promotions are designed to tempt buyers who might be hesitating due to higher interest rates and economic uncertainty. Even so, the market environment remains tough. The broader automotive industry is dealing with slowing demand for high-premium vehicles, especially in categories where prices have risen sharply over the past few years. Trucks are no exception. While they are still a top choice for many buyers, the total cost of ownership has gone up due to higher sticker prices, increased insurance costs, and more expensive financing. This is particularly challenging for Ford because its product lineup leans heavily toward higher midgeness vehicles like pickups and large SUVs. The company's move toward an affordable electric truck is partly a response to these pressures. Ford has already introduced electric models like the F-150 Lightning, but its price tag puts it out of reach for a large portion of the market. By targeting a $30,000 0-cent starting price for its new EV, Ford hopes to capture buyers who are interested in electric technology but unwilling or unable to spend the $50,000 0 cents or more that many current electric trucks cost. Achieving this price will be difficult, especially given the rising cost of raw materials and battery production, but Ford's management believes it is essential if the brand wants to compete in the long term. The transition to electric trucks is also politically and culturally charged in the United States. Some consumers are enthusiastic about EVs and see them as the future, while others remain skeptical about their range, charging infrastructure, and suitability for heavy-duty work. Ford is trying to position its upcoming affordable electric pickup as a practical tool rather than a niche or luxury product, hoping to appeal to the broadest possible customer base. This means the truck will need to deliver on both performance and cost, a balance that has been difficult for other automakers to strike. The investment in Louisville is a signal of how seriously Ford is taking this challenge. The reconfigured plant will not only produce the new electric pickup, but will also be a test case for the assembly tree method, which, if successful, could be applied to other models and facilities. Ford is betting that efficiency gains in production will be key to making lower-cost EVs profitable, something that remains a major hurdle across the industry. While these forward-looking moves are promising, Ford still has to address the issues in its current product line. The high recall count this year raises questions about manufacturing processes and supplier quality. Recalls can damage a brand's reputation, and in the truck segment, where reliability and toughness are major selling points, any perception of weakness can have lasting effects. For loyal customers, especially those who use their trucks for work, dependability is often more important than features or styling. There is also the question of how long Ford can maintain its current level of incentives without cutting too deeply into profit margins. Discounts and special financing offers can boost sales in the short term, but they can also train buyers to wait for deals rather than paying full price. If economic conditions improve, the company might be able to scale back incentives, but if they worsen, Ford could find itself in a cycle of heavy discounting that erodes profitability. Overall, Ford's situation in 2025 reflects the balancing act facing many automakers. The company is trying to innovate and invest in the future while managing the problems of the present. The affordable electric pickup project is an ambitious step that could reshape its position in the market, but it comes with significant risks, both in terms of execution and market acceptance. At the same time, the brand must maintain the quality and appeal of its existing models to keep current customers satisfied. Ram and General Motors are two of the biggest names in the American truck market, each with a long history, loyal customers, and strong brand recognition. In 2025, however, both companies are navigating a tricky environment. They are being forced to adapt to shifting consumer demands, tighter economic conditions, and the constant push to innovate without alienating their core buyers. The result is a period of transition where each brand is making moves that reflect both lessons from the past and the uncertainty of the present. Ram has had a particularly turbulent couple of years. In 2024, the company made a major decision that at the time seemed in line with industry trends. It retired its long-running Hemi V8 engine from its lineup in favor of newer, more efficient turbocharged inline-six powertrains. The reasoning was straightforward. Fuel economy regulations were getting stricter, and there was growing interest in engines that delivered better efficiency without sacrificing too much power. Ram's new twin-turbo six-cylinder option, known internally as the Hurricane engine, was designed to meet these needs and keep the brand competitive. However, the market reaction wasn't what Ram had hoped for. While the Hurricane engine was praised for its performance, many of Ram's most loyal customers were deeply disappointed to see the Hemi go. For decades, the V8 had been central to Ram's identity, offering a distinctive sound, feel, and sense of rugged capability. To a significant portion of the brand's audience, it wasn't just an engine option. It was a symbol of what a Ram truck was supposed to be. When sales numbers came in for 2024, they showed an 18% drop compared to the previous year, a clear sign that the shift had cost the company more than anticipated. In 2025, Ram's leadership made a surprising move by reversing course. The company announced that the Hemi V8 would return for the 2026 model year. This was framed not as a complete abandonment of its modern engine strategy, but as an acknowledgement that customer sentiment matters as much as technical progress. Ram's CEO publicly admitted that dropping the V8 had been a mistake and that the company had underestimated how important it was to its customer base. This kind of reversal is unusual in the automotive industry, where product planning cycles often stretch for years and public admissions of error are rare. It was also a clear signal that Ram is willing to adjust quickly when the market pushes back. The decision to bring back the V8 is likely to appeal to traditional truck buyers who value familiarity and proven performance. However, it also presents a challenge for Ram. as it works to meet emissions targets and maintain competitive fuel efficiency ratings. Balancing these priorities will not be easy, especially as more competitors offer hybrid or fully electric trucks that appeal to buyers looking for lower running costs and reduced environmental impact. Ram will need to position its returning V8 as part of a broader lineup strategy that offers something for both traditionalists and those ready to embrace new technology. General Motors is facing its own set of challenges, though they are shaped more by production and supply chain issues than by a single controversial product decision. In mid-2025, GM temporarily paused production at its Silao, Mexico plant, which builds some of its most important truck models, including the Chevrolet Silverado and GMC Sierra. These two models are not just GM's flagship pickups, they are among the best-selling vehicles in the United States. The pause was attributed to a mix of supply chain constraints and the need to manage inventory levels, but it nonetheless raised concerns about GM's ability to keep up with demand in a competitive market. Despite the production hiccup, both the Silverado and Sierra have seen year-over-year sales growth in the first half of 2025. Silverado sales are up around 2%, and Sierra sales have climbed roughly 12%. These gains suggest that GM's core truck products are still performing well in the marketplace, even if the broader environment is challenging. Part of the appeal is the breadth of options each model offers, from basic work trucks to high-end luxury trims with advanced technology and comfort features. This variety allows GM to target a wide range of customers, from fleet buyers to those looking for a premium daily driver. One of GM's advantages in the truck segment is its ability to scale production across multiple plants and brands. While the Silao pause was a setback, the company can shift some production to other facilities if needed. However, the fact that the pause happened at all is a reminder of how vulnerable even the largest automakers are to supply chain disruptions, especially when building vehicles that rely on complex global sourcing for parts and components. Both Ram and GM are also operating in a market where the definition of what a truck should be is evolving. For decades, the main selling points were power, towing capacity, and durability. These are still important, but buyers now expect advanced driver assistance features, improved fuel efficiency, and increasingly, electrification options. Ram has been slower than some competitors to roll out electric or hybrid trucks, though it has announced plans to launch electric models in the coming years. GM, on the other hand, has been more aggressive, introducing electric versions of both the Silverado and Sierra. The Silverado EV in particular has been promoted as a major step forward for the brand, offering competitive range and performance. The challenge for both companies is that while electric trucks generate a lot of publicity, they are still a small fraction of total sales. Many buyers remain hesitant due to concerns about charging infrastructure, range limitations, and the higher upfront costs of EVs. This means that for the foreseeable future, traditional internal combustion models will continue to dominate sales, even as companies invest heavily in electric platforms. Pricing is another area where Ram and GM must tread carefully. Over the past several years, the average price of new trucks has climbed significantly, putting pressure on affordability. Higher interest rates have compounded the problem, making monthly payments more expensive. Both brands have used incentives to help offset these costs, but there is a limit to how far discounts can go without eroding profitability. The truck segment has historically been a major profit driver for both companies, so maintaining healthy margins is critical. There is also a cultural element to how these brands operate. Ram has cultivated an image built on bold styling, comfort, and a degree of luxury that sets it apart from some rivals. GM's Silverado and Sierra, by contrast, emphasize versatility and broad appeal. These identities influence everything from advertising campaigns to product development decisions, and any shift in direction risks alienating parts of their customer base. The return of the V8 at Ram is a prime example of how customer identity can shape a company's strategic choices. Looking ahead, both Ram and GM will need to manage their transition toward more efficient and electrified trucks while continuing to deliver the models that have made them successful. For Ram, that means finding a way to integrate the beloved V8 into a lineup that also includes more modern powertrains. For GM, it means ensuring that electric models like the Silverado EV can coexist with and complement the traditional versions rather than replace them outright too soon. In many ways, their situations illustrate the balancing act facing the entire truck industry in the United States. Buyers want innovation, but not at the expense of the qualities that have defined these vehicles for decades. Economic conditions are making affordability a bigger concern, and competition is fierce, both from traditional rivals and new entrants focused on electric vehicles. The companies that succeed will be those that can blend tradition with progress, delivering trucks that satisfy both emotional and practical needs. One of the biggest shifts over the past few years has been the rapid increase in prices. Trucks that once occupied a middle ground between affordability and capability have moved steadily upward into what was traditionally considered luxury pricing territory. Base models are more expensive than ever, and higher trims with advanced technology and premium features often cost as much as well-equipped SUVs or entry-level luxury cars. This has forced many buyers to either extend their financing terms, pay higher monthly rates due to elevated interest rates, or move into the used market in search of better value. This trend is visible across the board. Honda, a brand traditionally associated with practical and reliable vehicles at reasonable prices, has struggled to maintain its affordability advantage in the truck and SUV-adjacent segments it participates in. While Honda is not a full-size truck manufacturer in the American market, it does compete with its Ridgeline in the midsize category. That truck was once praised for offering comfort, efficiency, and a more car-like driving experience at a sensible price. In recent years, however, the price of a new Ridgeline has crept upward, narrowing the gap between it and larger, more powerful models from other brands. The higher cost, combined with tougher financing conditions, has made it harder for Honda to attract the entry-level buyers it once relied on. These were customers who wanted a dependable truck without the financial burden of a premium model, and in 2025, many are finding that option out of reach. The financing environment is a major factor here. Interest rates remain high, hovering well above the levels seen just a few years ago. This affects all segments of the vehicle market, but trucks, with their higher starting prices, are hit particularly hard. Lenders have also become more selective, tightening credit standards and leading to more loan rejections. For brands like Honda, which have historically captured a significant portion of customers through affordable financing, this creates a double bind. Even those who are interested in buying may not be able to secure the necessary credit. Yamaha's situation, though more prominent in motorcycles than trucks, offers a parallel in terms of market positioning. In the truck world, the equivalent is the mid-tier brands that have built their reputation on delivering solid value and well-rounded performance without the premium price tag. In recent years, those mid-tier options have been squeezed as prices rise and economic conditions tighten. Buyers in this segment are increasingly hesitant to commit, even when the products themselves remain competitive. The hesitation stems not from dissatisfaction with the vehicles, but from the perception that waiting might lead to better deals, or that used options offer a better balance of cost and capability. The used truck market has, in fact, become a significant player in shaping new truck sales. In 2024, the North American used pickup truck market was valued at over $17 billion, and it is expected to grow at nearly 6% annually over the next decade. This growth is fueled by buyers who are priced out of the new market or who prefer to avoid the steep depreciation that comes with driving a brand new vehicle off the lot. For manufacturers and dealers, this creates a challenge. They must compete not only with each other but with their own lightly used inventory. Ducati's story in the motorcycle world, where exclusivity and premium pricing became a liability, has a clear counterpart among high-end truck brands. In the truck market, luxury-oriented models from established brands as well as specialist offerings from newer players have faced a reality check. Vehicles that were once aspirational purchases are now seen as risky investments, especially when resale values are dropping faster than expected. High-end trims of popular trucks can exceed $70,000, and for many buyers that price is harder to justify when interest rates are high and depreciation is steep. The image of exclusivity that once drove demand can turn into a barrier when economic conditions make affordability a bigger concern. Repossession rates are another worrying sign. Industry-wide repossessions of financed vehicles have risen by nearly 30% compared to the previous year. This is not just a blip in the data, it reflects the strain many consumers are under as they try to keep up with payments on increasingly expensive vehicles. Loan rejections have also climbed, with roughly 1 in 5 applicants being turned down. For truck makers, this means a shrinking pool of eligible buyers, even as they continue to produce at high volumes. Dealers have responded to this environment with a range of incentives aimed at moving inventory. 0% financing offers, cashback deals, bundled accessories, and extended warranties are being advertised more aggressively than at any point in recent years. However, these measures have had limited success in some cases. Buyers are more informed than ever, and many are choosing to wait for deeper discounts or for the market to stabilize. This leads to longer times for vehicles to sell, with some sitting on dealer lots for months. Suzuki's quiet decline in the motorcycle market mirrors the struggles of smaller or less competitive players in the truck industry. Brands that do not have a standout product, a strong reputation in the truck segment, or a clear value proposition are finding it difficult to justify their place in a crowded market. Without a niche to fill or a loyal customer base to rely on, these brands risk fading into the background, overshadowed by the dominant players. Another layer to the current truck market is the ongoing debate about electrification. While electric pickups have been heralded as the future by many automakers, their adoption has been slower than anticipated. In the first half of 2025, only about 35,000 electric trucks were sold in the United States, a slight decline from the year before. Factors such as range anxiety, charging infrastructure, and higher upfront costs continue to limit their appeal. This puts brands in a difficult position. They need to invest in electric models to stay relevant and meet regulatory requirements, but the immediate financial returns are modest. For the traditional internal combustion models, the competition remains intense. Brands that can balance performance, efficiency, and price stand a better chance of weathering the current storm. However, even these companies are not immune to the broader economic pressures affecting the market. The challenge is not only to build a good truck, but to offer it in a way that is financially accessible to the average buyer.